Hi, and welcome to another episode of The Income Generation, a new kind of show about saving and investing for retirement. Now, if you want the usual circus of ringing bells or scrolling tickers and Wall Street cheerleaders, which is how I would describe most financial analysts on TV, then I hate to disappoint you, but you simply won't find any of that here. Our focus is on real, no-nonsense news and information geared toward helping you, the income generation, make informed financial decisions. By that, I mean decisions that will help you avoid pitfalls and potential disaster and build a retirement nest egg that will help you meet your retirement income needs. It will also help you achieve your long-term goals. And in case you're tuning in for the first time, when I talk about the income generation, I'm talking pretty much about anyone who's already retired or within 15 years or so of retirement. That actually includes me, and if it includes you too, I urge you to stick around. You're not going to want to miss tonight's guest or hear his thoughts about how you might potentially make money in today's stock market. Now, this may sound a bit surprising considering what you learned on last week's show. In fact, if you missed us last week, we spoke with renowned economist and market historian Harry Dent. He gave us some less than optimistic insights about where we might be headed in the next few years economically and regarding the stock markets.
And I keep telling people, look at Japan, their baby boom, they had a real estate bubble, a stock bubble way before the U.S. and Europe because their baby boom peaked just before and after World War II. So way ahead. Now the U.S. is following and people say, oh, real estate will come bouncing back. No, it hasn't bounced back in 24 years.
Among other things, we talked last week about long-term secular market cycles and how those cycles have been repeating themselves throughout 200 years of stock market history right up until today. And even though I happen to share Harry's view of that long-term bear market cycle, the cycle that we both believe we're in the middle of right now and hasn't quite ended yet, we believe that the stock market isn't the best place to be for at least the next few years. Despite that, though, tonight's guest might have some counterpoints for investors who are still looking to be just a little bit aggressive despite where the market is right now. In fact, you may know Tobin Smith from his many years as contributing market analyst for Fox News or from best-selling books on savings and investing, including Change Wave Investing and Billion Dollar Green. But Tobin, who's our guest tonight, is also the founder and chief research officer of the next big thing, Equities Research. His company focuses on finding what it calls emerging secular growth sectors and hidden microcap stocks in the global economy. In other words, Tobin focuses on seeking out what he calls transformational change and disruptive technologies, companies and products that literally change society and the way we live. Now, obviously, there's enormous potential for growth in those kinds of investments when they come along, and a lot of them have come along even in the last 20 years. Now, just think for a moment about all the things that weren't around in 1995 that we now wonder and question how we ever live without. Things like iPods, iPads, eBay, GPSs, flash drives, or even the mouse on your personal computer. The point is simple. As Tobin will talk about, even in zero growth, 20-year or longer secular bear market cycles, similar to the one we're in right now, those in which the market drops 50% or more, like has happened twice already since the turn of the century, there can still be pockets of opportunity in the form of these transformative technologies. Even today, when you look at the individual companies that have done well since the Federal Reserve ended quantitative easing in October of 2014, and at that time the markets overall went flat, you'll see that some of these companies have done well include Google and Amazon.com. Two more recent examples of technologies that have changed life for most of us. I mean, remember the old days when you actually had to go to the store to do your Christmas shopping, or when you had to pick up a book or actually think in order to find the answers to a question? Those days are gone thanks to disruptive technologies. Brick and mortar stores and libraries haven't been replaced just yet, but they've certainly felt the impact caused by Amazon, Google, and others. Now, the question is it easy to identify the next Amazon or Google or Apple or eBay? The next big thing, in other words? Of course not, which is why Tobin has an entire company devoted to trying to help investors to do just that. For every device or service that changes our lives, there are thousands of others that never even make it out of the research stage, or those that do, but the market greets them with a resounding, no thanks. Or some that just get very quickly replaced by an even bigger, better thing. For example, remember laser discs? Remember Blackberries? I could list dozens of examples, and the one thing that all of these companies behind these failed products or technologies had in common was that they also had investors. Having said that, and despite the fact that I believe generally that the income generation should continue to stay clear of the stock market right now with at least the majority of their money, still, I wanted to have Tobin on because at the end of the day, I'm a realist. I know there are people who are always going to want to be a little bit more adventuresome with at least part of their money. That goes even for very smart and generally conservative people who understand the lessons of market history and know there's a very good chance we're going to see another major stock market drop of between 28 and 65% in the not too distant future. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I know there are people who are always going to want to be a little bit more adventuresome with at least part of their money. That goes even for very smart and generally conservative people who understand the lessons of market history and know there's a very good chance we're going to see another major stock market drop of between 28 and 65% in the not too distant future. Now, how close is that drop? How risky is the market overall right now? Well, that's what we're going to talk about in tonight's market breakdown. Now, even though it's a big part of any financial professional's job to try to forecast what comes next, I've always said that trying to pinpoint an exact date for the next market disaster is a fool's game. It seems to be pointless except for one of those talking heads on TV, hoping that you can get a good "I told you so" soundbite out of it if he just happens to get lucky and guesses right. But still, he'd only be guessing. Besides, the exact date is irrelevant. All everyday investors need to know right now is that, as we talked about last week, we have over 200 years of market history, which tells us clearly that the next devastating drop is overdue. That's what's most important. Now, why is it overdue? Simply because, and this is what we talked about a lot in last week's market breakdown, the influence of quantitative easing. This QE, as it's called, QEs 1 through 3, were supposed to jumpstart the economy. You probably remember that. Well, they succeeded a little bit, but they really didn't do a fantastic job of this jump-starting. But they did make Wall Street really happy by creating cheap money and driving everyday investors up what we call the risk curve. That's mainly, in fact, why the markets continued to climb even after the Standard & Poor's 500 and the Dow Jones Industrial Average both surpassed their previous peaks in 2013. Those peaks I'm referring to are the ones from 2000 and 2007. The markets by then were no longer being driven exclusively by economic fundamentals, but instead by what I call economic steroids, by an artificial drug injected by the Federal Reserve. But in 2015, we've seen some dramatic change. Why? Well, because this QE, or quantitative easing as we call it, finally ended in the United States in October of 2014. Since then, we've seen record volatility, and we've seen the steady market climb that's been going on for the 5 years previous come to a grinding halt. In fact, right now, the S&P 500 is about where it was a year ago, basically in the same place. Now compare that to early December of 2013, when it was at 1,805, or early December in 2012, when it was at 1,418. Right there is the difference between economic steroids and no economic steroids as far as the markets are concerned. 400 and then 200-point growth in a single year with quantitative easing in place, followed by virtually no growth the first year that it's taken away. What's also important to understand is that probably the only reason the markets didn't nosedive after QE3 ended is that Europe's economy took a turn for the worse at about the same time. Europe learned a lesson from our playbook and began its own economic steroids in the form of quantitative easing, which has indirectly held down our interest rates and continued to push U.S. investors toward riskier assets. As I said before, up the risk curve. This has at least kept the markets propped up in the midst of all this volatility, even if they've stopped the upward climbing trend. But how much longer can that continue before history and basic economic fundamentals win out? As you know, the stock market took a historic 4-day plunge in late August as a reaction to worries over China's economy. It ended with the Dow dropping 1,000 points in a single day on August 24th. A lot of people came to me at that time saying, is this it? Is this the start of that third major drop you've been talking about? After all, we've already had two since the turn of the century, the first when the tech bubble burst, and the second with the financial crisis. My answer? Well, it could be, but the jury's still out. Even though the markets have rebounded since August, the volatility hasn't really lessened in any way. In addition, the situation in China that triggered the plunge hasn't really improved at all. It's very possible we're just in sort of a holding pattern now until some other skeleton falls out of the world's economic closet. Now, whether that next skeleton is going to be China or Greece or even geopolitical concerns, for example, ISIS, whatever it is, it could very well trigger another historic tailspin that doesn't quite manage to pull up this time. A drop that just keeps going until it hits the benchmark that 200 years of stock market history says it has to hit. A 28 to 65% decrease from today's levels. That's right, 28 to 65%. Now again, I understand that even among people who are aware of all this, there are those who like to gamble just a little bit and are going to want to take some risk in the stock market, no matter what. So one of the things I'll have my guest Tobin talk about is investing in transformative and disruptive technology as an alternative to diversification. Why? Because if you're going to be in the stock market at all, which means you either have savings to risk or you have a long, long way to go to retirement, I believe you at least have a better shot of getting somewhere in the stock market with the first strategy instead of the second. You know, now a lot of advisors talk instead about diversification as a smart strategy and smart way of doing things, but I think most of them have ulterior motives. Statistically speaking, if you are in 20 or 30 different stocks, then you're about as diversified as the stock market overall. So the reason that I believe a lot of advisors push diversification is that it's safer for them. You see, it's easy enough to tell a client whose portfolio is down X% that it's because the market's down. You know, after all, Mr. Client, we're all in this together. But on the other hand, if that client's portfolio is less diverse and ends up being down 30% or more than the overall market, then that advisor has some splaining to do, Lucy. And the market overall is, like I said, on a path to deliver 0% growth between the year 2000 and the time that this secular bear market cycle finally ends, whenever that is. So ultimately, that's what stock market diversification will give you. So as much as I would caution against having much or any stock market exposure right now, given market history and given the market's at a record high, especially if you're near or at retirement, I still would agree that a speculative strategy in the stock market, ironically enough, might be preferable to a diversified stock market strategy. In fact, transformative and disruptive technologies are probably the only option for potential growth in what we call a secular bear market cycle, again, like the one that we're in right now. I will at least be able to agree with my guest, Tobin Smith, on that score. And we'll be right back to talk with Tobin after this message.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Toby, welcome to our show.
Thank you. I am the income generation.
And so am I.
I think we're all the income, so I love the idea of the show.
Great. Well, good to have you here today.
Thank you.
Tell us about your company, the next big thing, equities research.
Well, we've always focused on transformational change. And so, simply speaking, it's the world's greatest wealth creator. It's also the world's greatest wealth destructor. And I think, we've seen both sides of that. As it applies to income generation, to actually earning income, we've looked and worked in a lot of alternative income generators. So for instance, master limited partnerships have been a very popular investment. Real estate investment trusts are maybe a little bit different than the average bear. And then bonds, and just sort of, corporate bonds, but not AAA, not junk, but sort of the mid-level, a 1% default rate, and I think we can stock pick, right? So if you combine that, my message is that many times people will get in, for instance, to a master limited partnership, and a broker will call them and say, look, you're going to get a 9% yield, and you don't have to pay taxes on it, or 85% tax free, no risk whatsoever. And yet, there's many people sitting here today that own a master limited partnership that, let's say they paid $40 for that per unit, and that unit's selling for $20 today. I mean, there's many like that. Or many like that. I mean, their average price are down about 35, 40%. And that's not coming back the way that it did, because they were in a transformational event, this whole fracking world in the United States, and people sort of got visions of sugar plums in their head and said, my gosh, we're going to be going from 9 million barrels a day to 20 million barrels in the United States, and we better build every pipeline we possibly can. Well, guess what? It's a cyclical business. The faster something transforms, the faster something saturates. So whether it would be, fiber optics in the late 1990s or fracking oil coming out from 1 million barrels a day to 7 million barrels a day, at some point in time, you've hit a saturation. So my point is that if you get in master limited partnerships, for instance, or you got in a real estate investment trust that you really don't understand, there is principal risk involved there. And I think if anybody tells you other than that they're lying to you, or they don't know enough to be an advisor.
You said a few minutes ago that transformational change is the biggest creator or biggest destroyer of wealth. Can you give me an example of each one, or maybe one where it was a big creator and then subsequently a big destroyer of wealth?
Well, let's look at my fair friend Harold Hamm from Continental Resources. So he had this idea that you could drill sideways into rock, because shale is just rock, right? And somehow the hydrocarbons, the oil, and the gas would come out, and people said he was crazy. So he leased a bunch of land up in Continental Resources, the ticker symbol is CLR, right? And lo and behold, he was right. So oil prices went up, his inventory went up, his reserves went up, and so he was worth, at one point, $7.5 billion, and shareholders had about a 50-to-1 return in their stocks. It really wasn't an income stock, it was a growth stock. But again, that same stock today is down 65%. People who bought it at the high are not even getting a dividend. And my point is, almost by definition, anything that rises quickly, by definition, is getting to a saturation. So it could be something like a Blockbuster. If you think back to that company, and you could actually go to a video store and rent it. How great is that? They have 5,500 stores around there. Then this thing called Netflix happen. So they were the disruptor, and Blockbuster went like this, and people, and then Netflix came, and now Netflix, the stock is up 31,000% if you take it from the bottom, and Blockbuster's out of business. I mean, it happens, that cycle happens time and time again. In income, in bonds, because I'm a big fan, again, of sort of this corporate mid-level bonds, 1% default rates. But again, you got to look at the company. So the person who bought the bonds in Continental Resources, for instance, those bonds are selling at 70 cents on the dollar. People who bought in a quote-unquote safe energy companies have bonds, those that are down, 20%, and they're never going to get that money back. I mean, unless the world changes. So I guess my big message here is, if you're not buying sort of straight ahead bonds for income, you can't buy and forget. There is no buy and hold forever in alternative ways of getting higher rates of income. And let's face it, when you're getting 25 or a quarter% out of your money market account, or you're buying a 10-year CD at the bank and getting 1%, people need more income.
So it's not like the George Foreman grill. It's not set it and forget it. Is that what you're trying to tell me?
And you can get burned.
Our viewers want to hear set it and forget. They want it to be
on
simple.
The George Foreman grill too, by the way. But that's a great example.
You get burnt on any grill. That's the problem.
The company that started that, that owned the rights to that, did fabulously well until people actually used the George Foreman grill to a certain point, and everyone who was crazy enough to operate that grill, bought it, had, and the same thing, and they went exactly that way.
I don't know about you. Maybe it's that bad experience. Mine worked quite fine, I must admit. But
for grilled cheese sandwiches, come on, man. I'm not for grilling anything. Yeah.
Let me ask you though. Yeah. You talk a lot about investments that give cash flow of 10 to 12%.
Right.
And of course, as we all know, and as our viewers know, that cash flow is not necessarily the same as income, which is obviously my main focus.
Sure.
So can you tell our viewers a bit about the difference?
Well, again, it's a great example. So if I'm a master limited partnership or real estate investment trust, I'm getting cash flow in, I get rents, or I get whatever, I'm selling sand, whatever it is, and by law they have to distribute 90% of whatever that cash after expenses is. So that's cash flow. But many times, to maintain their dividend, their distribution, they will also borrow money, or they will do other things to enhance that. And that's the number one red warning signal. So anything we look at in the alternative space, whether it's, and we happen to like medical centers. For instance, Omega Healthcare, OHI, we've owned that for years. Income has gone up every year for 12 years. I think we bought the stock as an income stock at $8, maybe $5. It's now a $35 stock. So there are things such as income and growth if you get the right trend. But they've never distributed more than the income they've got in rents. They haven't done sort of these fake accounting games. And so again, if you're going to stay out of the straight ahead bond business and get a little bit outside of it, you can't just, your advisor, whoever you're working with, you can't just say, well, gosh, they distributed 9.1%. That's their dividend. Well, where did that dividend come from? So you want to have 120% coverage of whatever you're paying out, so you're not paying out, or there's 80%, you're paying out 80% of what you're earning. Some of these companies will be, earning a $9 dividend, and they're paying a $10 dividend. Well, where did that other buck came from? It comes from refinancing, it comes from lending, blah, blah, blah. And that all looks great. It's like Warren Buffett says, it's only when the tide goes out you find out who's swimming naked. And the company that's paying a dividend that they can't support from their own operations is swimming naked. And when that happens, you wake up one day and it's on the news, and that stock, the company's down 25, 30%. It happens every year. And the people who said, I just wanted to buy this and, and just keep clipping coupons, if you're getting above, way above what normal treasury bills are paying, by definition, you're taking on more risk. We try to mitigate that risk by following trends.
But speaking of treasury bills, it sounds like what you're saying is that the corporate America cannot do what the U.S. government can. It cannot keep incurring interest on debt that it can't pay from tax revenue.
Correct.
So with that thought, we're going to take a break. And when we come back, we're going to ask Toby some important questions, some direct questions. Specifically, you're going to learn which industries he's recommending right now. We'll be right back. This is fun. This is great. 3, 2, 1. I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, You too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. We're here with my good friend Toby Smith. He's talking about transformational change.
Thank you.
You talked right before the break about watching out, being careful and cautious of investments that promise cash flow of 10 to 12%. Because sometimes these companies can't really afford to pay that much out. So there's a difference between cash flow and income. Yeah. Can you tell our viewers for just a moment what percentage or what range of percentages you can reasonably expect in income-generating investment vehicles?
Well, if you just stay at this, so there's this idea called a preferred bond or a preferred stock that basically gets all the income that gets paid to them first, and then if there's anything left goes to the next level, right? So preferred. So Apple stock, for instance, I mean, we've done wonderfully owning Apple, and we understand that business very well. My old research firm, ChangeWave Research, we were one of the first people to buy that stock, right? When they started selling the bonds weren't paying very much. I mean, their bonds are paying a 2% yield, but there's still preferred shares out there that you can buy. And if you take the dividend from Apple plus the preferred and then this appreciation, that's been a wonderful combination. The reverse of that is you could also have bought BlackBerry, in other words, a descending company, right? I just was on a plane recently, and there was like one guy with his BlackBerry there, and he just looked like a dinosaur, like.
And he had his iPhone in his jacket pocket as a spare, right? Just in case.
But look at BlackBerry had preferred bonds, preferred shares, et cetera. They haven't paid an interest payment on those, et cetera, et cetera. The stock obviously has dropped, 90%. There's business risk, and then there's interest rate risk, and those are two separate things. And so again, if you're going to step outside of the safe and sane treasuries and so on and so forth, then you're going to have to look at some business risk. Also, defense companies, for instance, now, I mean, with what's going on in the world today, obviously their revenues are going to be larger, and they have some pretty attractive, bonds. I don't like the convertible stuff. Convertible stuff, it seems to me, you are their income.
More complicated.
It's more complicated, and blah blah blah. I mean, if you want to buy the stock, buy the stock. If you want to buy the bond, buy the bond, right?
I agree.
But Lockheed Martin's got some decent paying yield, and I know you're a big bond guy, but we certainly like to match these durations. The great thing about a bond, as long as you hold it to maturity for a great company, you're going to get your money back.
Of course.
And so we're looking at ascending industries, certainly the cloud, for instance, cloud computing, everything involved in that. Well, there's some companies that own Equinox, is for instance a company that owns a real estate trust. It is a real estate trust that owns data centers. And they have preferred equity that pays, a 6-7% yield. The stock itself has gone up, 800, 900%. So if you had sort of 90% in that bond preferred, and you had 10% in the stock as your little equity kicker, then all of a sudden, we have people who've doubled or tripled their money in Equinox just on their 10% piece, and the yield has continued. So now you're growing, your portfolio and getting income.
So realistically, then, what percentage dividend rate would you tell your clients that they can expect in investments like preferreds, for example?
Yeah, these are 5 to 6.5%, 7%, for the corporate mid-sized companies. If you're looking at REITs, real estate investment REITs, obviously as interest rates go up here, REITs start to lose value because they're competing with the no risk cost of funds, right? But I think as we get down the road, I think we're getting no more than a 2% federal funds rate for a variety of reasons. And according to the fact that the Fed has said the same thing, right? So that means the 10 years are going to price off of that. And now I'm going to be comfortable in buying REITs again. And I love medical REITs, all the medical REITs, Ventus, medical properties, because they have built-in escalators in their rents. They participate, some of them participate in the actual businesses. They get overages.
So it gives it less interest rate risk.
It's less interest rate risk, and those rates have continually gone up, and obviously 10,000 boomers a day are turning 65, and you consume about 70% of all your health care, from age 65 and on. And so, that's a growth industry that is going to grow no matter what.
So today, realistically speaking, somewhere up to 7% is
Yeah.
what people can expect through interest in dividend-bearing investments. If it's over 7%, then you'd say be a little cautious.
Well, if it's over
correct?
7%, then there's a reason why it's over 7%. In other words, and even if the company, earns $1 and pays out 80 cents, but let's say, for instance, it has interest rate risk, they'll continue to make that pay. You'll get your 7% or 8% or 9% payment, but the value, the principal of that REIT or some of those MLPs, et cetera, is going to go down in value. And it's not like there's, it could go down in value for a very long time. I mean,
Sure.
you're taking principal risk and interest rate risk. That seems like a bad combination.
Which is right, exactly. It's a double whammy.
It is a double whammy.
So now the tough question.
Yes, sir.
Okay, I told you I wanted you here because I respect you, I love you dearly, but now you have to tell our viewers, what sectors today would you recommend that people consider in this realm of investing?
Look, first, I love the medical space. So any part of the healthcare space makes sense right now as long as you're not overpaying. And United Healthcare, for instance, has preferred. They have bonds as well as their equity that pays a nice dividend. United Healthcare said they're going to stop offering Obamacare, which to me is a great idea for a variety of reasons. Starting with they're losing money at it. And so the stock,
we don't have enough time left on the show to talk about
so
Obamacare.
the stock came back a little bit, so I think they're buy. I like Molina Healthcare. So they're running the Medicaid plans. They're going to continue to do that more and more because the states won't run that. They don't. It's not a dividend paying, but it also got pulled back here. And then in the big picture of where healthcare is, we liked Pfizer. They just recently said they're going to merge. They're going to go. Can you blame them? Can you blame them? They're going to go to Ireland and they're going to get a 12% tax rate where they get 35 here in the United States.
Well,
wouldn't you?
They should be patriotic and they should pay their fair share.
They absolutely should. But you know what? Every one of their competitors aren't. And I believe in the free market and free enterprise. If all your competitors wake up in the morning and have a 30% advantage over your profit margin simply because they moved their office to Ireland.
And let's not forget their fiduciary responsibilities to whom?
Exactly right. To the shareholders. It's not to
which is to maximize after-tax profits.
Right. It drives me nuts. And it's amazing that both the Democrats and Republicans couldn't come together on this issue.
Yeah.
It just is. But
common sense, you'd think.
But those ones, all that sort of has basically happened. And I think this Pfizer thing will be the final death knell. It's like in Canada, Bell Canada, which we owned for a long time, decided they wanted to become what's known as a royalty trust. And the Canadian government said, all right, no mas. And I think Pfizer, this is going to be the last, inversion because it's a big company. This is a 120 billion when you put it all together, and it's lost to American taxpayers.
By the way, I don't think they say no mas in Canada. I'm pretty sure it would be the French equivalent of no mas. I'm not sure what that is.
Yeah, something, yeah.
Well, I can't believe time flies when you're having fun, and we're out of time. And I wish I could have you here for the whole show. But since you and I see so eye to eye, I like to take a vacation every once in a while. Will you be my replacement host when I need to take a week off, please?
I'm the professional guest host, by the way. That's what I do. I don't want to really do that all the time, but it's fun to guest host because I mess up. It's only, I'm only a guest.
You're only a guest.
It was your fault.
That's right. Okay. Well, you heard it right here on this episode. When I'm on vacation, you'll see my good friend Toby Smith here in my place.
You live in Florida half the year. That's vacation right there. I don't even know what you know.
Don't talk about that. All right. Well, that's it. Don't go anywhere. We'll be right back with a lot of important tips of how to protect and maximize your income as an investor. Be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. If you watch any sports at all, you'll know that you cannot sit through 15 minutes of a game without seeing 5 commercials or more about FanDuel, the fantasy sports betting website. Now, as you may know, the New York State Attorney General last month issued a cease and desist order to FanDuel on the grounds that it constituted and promoted illegal gambling. Now, FanDuel says that that's not true, and they're currently fighting it in court. But you tell me, you participate in FanDuel by betting money on games and athletes with the chance of making more money, but also the chance of losing all your money. Is that gambling? Well, I will let you answer that question. So why am I bringing this up? To make the following point. Again, I understand there are always going to be people, including many people in the income generation, who want to gamble with some portion of their money. The popularity of sports betting websites definitely supports the idea that people want to do this and want to do some level of gambling. But I know from personal experience that some of these same people try to deny that investing in the stock market is just another form of gambling. Of course, I've always said otherwise, and when I heard the FanDuel story, it got me thinking. Playing the stock market and betting on sports really have a lot in common. Think about it this way. What's the difference between a team owner, like for example Stephen Ross of the Miami Dolphins, and someone who's just betting on his team? I mean, they both want the team to win because they both want to make money when the team wins. But which one of them is gambling and which one isn't? Well, if you're Stephen Ross and you own the team, you have a say in choosing who the players are, who the coaches are, as well as some of the strategies that they utilize. You can have a positive effect on the game's outcome. But if you're someone betting on sports, betting on the team, you simply have no way of having any effect at all. By the same token, what's the difference between Warren Buffett and the average stock investor? Well, it's quite similar. When Warren Buffett invests, or someone like him, he'll usually buy controlling interests in these companies, or at least large enough interests that he has a seat on the board of directors. In that way, he can control the management and the direction of the company. The average investor, however, simply cannot do this if they're buying just a few shares of stock. All that average investor can do is bet on the company's managers, hoping that they do a good job. So that's where I see betting on the stock market as being very much the same as fantasy football or gambling on sports or any kind of gambling for that matter. You're buying fractional shares in a company in which you have no control at all, hoping that it succeeds. In essence, you're betting on the management team, much like in sports when you're betting on the players. In fantasy football, you're betting on those players to do well next Sunday or in the game your way. Similarly, when you buy stock, you're betting on future profits. And even if things go well and the company's profitable, the management could still do something silly that causes it to fall out of favor with Wall Street. And let's face it, the fickle whims of Wall Street can still drive the stock price down no matter what. So to me, that makes it even riskier than betting on sports or gambling on a casino. In fact, the stock market to me is like gambling on steroids. So the point is, if you're bound and determined to gamble on the stock market, even knowing where we are now in the course of our long-term secular bear market cycle, I ask you simply this. Don't kid yourself about what you're doing. Understand that diversification does not equate to protection, and that even the next big thing is never a sure thing. Hopefully our guest today has given you some helpful food for thought on that topic, and I'd like to thank Tobin again for stopping by. And I hope I've also given you some more food for thought about what it means to be part of the income generation. It means we have unique challenges and live in uncertain times, times that I believe call for focusing on the kind of conservative, actively managed investment options, not for growth, but instead that are geared for dependable income, conservatism, and reasonable growth, regardless of stock market conditions. Next week's guests, Peter Morisi, has lectured and provides executive programs at more than 100 institutions, including Columbia University and the Harvard Business School.
And longer term, you really can't solve the economy's problems with monetary policy alone. We have gotten all we're going to get out of easy money.
In fact, his views are frequently featured on CNN, CNBC, and right here on Newsmax, as well as other top-ranked national broadcast networks around the world. So go ahead and mark your calendar. Same time next week. I look forward to visiting with you then.
right now. Log on to theincomegeneration.com. Then download your free special report. That's theincomegeneration.com.